Bienvenidos al lanzamiento
Welcome to the launching of the economic report, Preparing the Macroeconomic Terrain for Renewed Growth.
Welcome to the launch of the IDB Macroeconomic Report, Preparing the Macroeconomic Terrain for Renewed Growth.
We have simultaneous interpretation in this event in English, Spanish, and Portuguese. Please select the world icon on your screen. I will now give the floor to the IDB president, Mr. Ilan Goldfein. He has some introductory words for you.
Adelante, por favor.
Buenas tardes, good afternoon. It's wonderful to be here. I extend a warm welcome to everybody in headquarters, and I understand that we also have you connected remotely. I'm also connected remotely. We just came from Panama yesterday for our annual meetings. And we're already here pleased to introduce the official launch of the IDB 2023 Macroeconomic Report titled Preparing for the Macroeconomic Terrain for Renewed Growth, which, as I mentioned, we were in the annual meeting, we presented to our governors just 2 days ago. Our region is facing a triple macroeconomic challenge that is limiting the development of the Latin American and Caribbean and the welfare of its population. Let me tell you that the first challenge is social. There has been an increased social demands. Societies have less patience to wait for more years or decades to reduce poverty, especially to reduce inequality. Today, you have 30% of the population living on less than $5 a day. And inequalities today is comparable to those in 2011. The region needs to improve its poverty, improve its income distribution, but not only income. There are inequality issues related to other dimensions, gender, diversity, and others. And the population is also demanding better quality and quantity of social services, including health and, importantly, education, but also new services like connectivity, and they do care about climate. So governments are under pressure to provide better public goods, better services, but, and this is the second challenge, they have fiscal constraints. And the fiscal constraints have gotten worse. The pandemic had a significant impact on public accounts and higher level of debts because they use a bit of the fiscal space for that, even though the debt levels have gone down from the first pandemic years. It's still the case that we are now having more fiscal restrictions and higher debt in average. So you don't have space to provide all the resources you need for better public goods and the old social issues I just mentioned. So the question always is, well, why don't we create these resources? And this is the third challenge, growth. Well, the region long-term growth is only 2%, which is low compared to other regions. And the main culprit is, of course, low productivity, which is the main reasons for poor growth in general, but in particular in the region. So what do we need to do? Of course, improve labor, technology, promote inclusion, fight informality, which is less productive, create institutional environment for more productivity, and of course, all the IDB work on infrastructure, both physical and digital, institution building, and everything we do to increase productivities. So we have now three challenges: more demand for services, more impatience, more fiscal constraints, and still low growth. In a world where you are now also affected by climate change. So those challenges are interrelated, they're difficult, and we need to face it in the Latin America, Caribbean region. And that requires complex policy agendas, ambitious policy agendas that focus on medium and long-term actions to transform our economies. If we are able to do that, we will be able to have some more degrees of freedom and be able to attend what governments are now under pressures. At the IDB group, IDB Invest, IDB Lab, we want to be agents of this change and be able to improve the conditions of the citizens in the region by giving some space and allowing governments to have space with these triple challenges. Now, while we look at these triple challenges, this was not created this year nor last year, not even after the pandemics. It may have gotten worse, but those are structural issues and structural challenges. We do have short-term challenges. You know that the current global environment is quite volatile and uncertain. With factors such, we have lower growth forecasted, and you'll hear from this report, not only for our region, but in general. You have more global financial stability. And I don't need to tell you in these last days how financial stability is a concern. And as you can see from the report, you will see that we are touching on scenarios where the financial uncertainty is key. There are concerns about inflation, although inflation is going down, it's still high. And of course, the evolution of the war in Ukraine, the invasion of Russia on Ukraine, also is an uncertainty for 2023 going forward. So mitigating these short-term issues is critical to avoid deeper issues and ensure progress towards the medium and long-term challenges. So the report prepared by the Research Department specifically examines the regional short-term and the cyclical fluctuation and the short-term uncertainties and proposes policies to mitigate their impact. We hope that this report will contribute to the policy discussion, which already happened during our governance meeting, which we carry out with great effort and hopefully with a lot of enthusiasm from our colleagues in the research department, so that we can ultimately improve the lives of Latin American Caribbean citizens. Let me now hand over the microphone to Eric Parado, our Chief Economist and Manager of the Research Department, who will introduce the report, our speakers, and discuss. And let me thank you all, speakers, discussants, Research Department, Eric, and all of you here joining us for being here and being with our Research Department in this endeavor. Thank you very much.
Thank you very much, President Golfin, for your words of welcome. This is evidence of the President's commitment to these topics. He is in Panama, as he said, discussing these very topics, and we have this momentum right now to work on these topics. And as the President said, this challenge is so urgent and so important that we need to take action. We need to look at all the diagnosis and all the policy recommendations for each one of the countries, and that's what we want to do in this report. Once again, thank you for being with us here in Washington, D.C., those of you who are with us, and all those people as well who have joined us from other parts of our region. Before we begin, I'd like to take this opportunity to thank the editors, Victoria Nuger and Arturo Galindo, for their commitment to this work, to this region, for the support they provided to their IDB colleagues so that we could provide good information, useful information, and recommendations. So thank you very much for your excellent work. And of course, there are a lot of people behind this. I want to thank the whole editorial team, Tom Saracen, and the rest of the team for their amazing commitment to this project. It's now our tradition. We have the fiscal and municipal team of the IDB participating as well. Thank you for your work. And I want to especially thank the labor market team and other colleagues from the Vice Presidency of Sectors and Knowledge of the bank and many other colleagues from the institution who have contributed to this. Thank you to all of them. And for the Vice Presidency of Countries, thank you for your comments, your revisions and suggestions, and for all the support we've received from you. Sometimes we forget to thank our research assistants from the research department, but they contribute to each one of the stages of production, from compiling data, reviewing the diagnostics, and of course, in looking at more policy-oriented recommendations. As President Golfin said, our report this year is titled Preparing the Macroeconomic Terrain for Renewed Growth. We're going through difficult and uncertain times in the region and in the world as a whole. What makes Latin America and the Caribbean different is we really need to pay attention to how the world economy is going to affect us. And growth has been lower than we had before worldwide. This is linked to the inflation crisis we had last year, and we are still going through it. And we are still uncertain as to how it will be resolved. We are looking at some bright spots, though, in this regard. But inflation did leave us with high financing costs, and this is a condition that Latin America and the Caribbean need to address now. And we have three or other sources of uncertainty, and we don't know what the end result will be. One of these three sources of uncertainty is the volatility that we see in financial markets, in particular in banks in some parts of the world. And we see this with concern, not just because these are the traditional channels for financing, but also because they can affect monetary policy in advanced countries, and because this is also linked to inflation, global inflation, which can affect our economies. This, of course, is with the background of the war in Ukraine, the possibility that it might go on for a longer time. This will have also repercussions on the world economic order, and this, of course, will affect Latin America, as we have been seeing already. And finally, we have the return of the reactivation of Chinese demand after their post-COVID-19 reopening of their economy. All of this could have an impact on our economy. And at the IDB, as President Golfin said, we want to help the countries design policies to mitigate or alleviate the impact of these elements on their macroeconomic stability. We need fiscal policies, monetary policies, and labor policies, among other economic policies, in order to protect the stability of the economies and to promote long-term sustainable and inclusive growth. And long-term, we want to close these gaps that the president mentioned, the challenges he mentioned socially and in terms of long-term growth in our countries. So here we discuss some ideas to feed into that debate. Today's presentation will be by Victoria Nuger and Arturo Galindo from the research department. They will be presenting some of the highlights of the report. It's about a 25-minute presentation. And then after that presentation, we have two excellent panelists Solange Bernstein, who's with us from Chile, and Pablo Guidotti, who's with us from Argentina. And they will be offering their comments and reactions to the report. The report is already available on our website. There's a version in Spanish, one in English, and one in Portuguese. So we encourage you to download and read the report. And now I give the floor first to Arturo and then to Victoria. They will be introducing the report. Good afternoon, everyone. It's our pleasure today to launch our 2023 macroeconomic report today. It focuses on our challenges. And as our chief economist, Eric Parrado, and our president, Ilan Goldfein, mentioned, this is a crucial time in terms of being able to deal with our challenges, medium and long-term challenges in the region. The short-term ones are critical and can also in turn complement more long-term policies that the region needs in order to address these challenges. And that's why we have this title, Preparing the Macroeconomic Terrain for Renewed Growth. I'm having some trouble advancing the slides. As the president and Eric were saying, the region has a triple challenge in front of it. We have social challenges, fiscal challenges, and a growth challenge as well. And in addition to this, we have some challenges that we could call cross-cutting challenges related to climate change, diversity and inclusion, and institutional capacity building to promote the development of the private sector. And all these elements together mean that policy design to successfully address the region's challenges is a very complex task. We can think about mechanisms for planning out in the medium term what we want to do, but we also need to deal with short-term fluctuations to prevent a temporary situation from becoming worse and deeper. Now, how do we address this and how do we implement policies that will help mitigate the effects? That is the content of this report. So we're going to talk about the current situation in the region as it relates to the macroeconomic context. There are some growth scenarios for the next few years, then immediate challenges for policy, macroeconomic policy in the region. And then we present some ideas behind some potential policy agendas that we feel we can discuss. It's a contribution to the discussion. Let's look at macroeconomic prospects. Growth prospects are lower than had been predicted for 2023. This is the case for almost all economic blocks. It is calculated that global growth this year will be about 1.8%. That's about half of what it was in 2022. And this is due to a great extent to the shock of Russia's war in Ukraine, which the way it's affecting commodities has caused this problem, and policy responses, monetary policy responses meant an increase in the cost of financing. And so this year we begin with substantially higher financing costs. And the world situation might become even more complex to the extent that there are difficulties with this new financial stress that we are seeing now in the US and in Europe. For all the blocks we've shown on this slide, well, we only see greater growth in China because of the relaxing of the very stringent measures that they had for COVID. And this can have different effects. It can stimulate global trade, and this would be positive for the region, but it could also generate pressures on commodity prices, again leading to price increases and a dynamic similar to what we saw with inflation in 2022. So this is something we need to monitor as this reactivation of China develops. And expected growth is low, and this could affect our region as well, other than China. Now, in this context, Latin America and the Caribbean had a growth of about 3.5 or 3 to 3.9% growth in 2022. Growth will be only 1 or 1.1% in 2023. And raw material prices increased significantly last year. Commodity prices increased after the invasion of Ukraine. There has been a certain level of correction, but prices are still relatively high, although a bit less volatile. Here we see three key commodities for the region and how they're doing. These prices remaining high might be good news in terms of income for those countries that export these commodities, but it's a problem for those that depend on importing them or for those that subsidize them. And this is very common, in particular relating to gasoline and other fuel subsidies. Even for some commodity exporters, perhaps the net effect will not be positive for them or will cancel it out. Regarding prices of commodities, last year we saw a general increase in the prices of goods and services all over the world. Central banks responded with monetary policy. This increased financing costs for the public and private sectors. Here we see the cost of average cost of sovereign financing for countries, treasury bonds of the US 10-year bonds, and the spread. In 2022, bond yields increased by 3 percentage points, close on the heels of the monetary policy response. Now the bonds are about 4%. The NB, the spread, is constant, more or less consistent for most countries, although there were some heterogeneous movements within countries. But now financing costs that the region must deal with today are high. And as this graph shows, they are at the same level or even worse than during the worst time of the pandemic. There's this new, as I was saying, financial stress in the US and Europe, and this can affect these prices as well. We don't know in which direction yet, though there's a lot of uncertainty regarding the meeting tomorrow and other meetings of the Fed regarding what decisions they're going to make about interest rates. A week ago, markets were predicting that the Fed rate would end the year above 500 basis points, but now there's a high likelihood, looking at numbers coming out of the markets, there's a high likelihood that the rate will be under the current range. That's about 450 to 475 basis points, and projections coming out of the market give greater likelihood to the rate ending 2023 at 400 to 425, within that range. So there's a lot of volatility and daily fluctuations in this regard. At the same time, in parallel fashion to these macroeconomic events, we need to look at the different social dimensions in the region. In the last 8 years, the region has been recording increases in poverty and inequality. There was a favorable trend that had started at the beginning of the new century, but in 2014, approximately, that trend was reverted. Now poverty is growing. The pandemic meant that these numbers increased, and there was a slight correction, but then they went back to that increasing trend. And when we look at the challenges in the region now, this these challenges could also have the effect of increasing poverty and inequality. How do we revert this, and how do we go back to a positive trend of decreasing poverty that we had at the beginning of the century? That continues to be one of our key challenges.
Given this lower growth, global context, and higher financing costs, we asked in the report what growth scenarios would be faced by the region in the coming years, the next 3 years. And we built and created a number of scenarios using a global model of self-regressive parameters. We established a baseline where we expect that the growth in the region will go down to 1.1% this year and will gradually increase up to the projected long-term growth of 2% by 2025. And what we do with this scenario is to apply different stress points in different ways through the incorporation of economic shocks in the US. So when we shock the US economy, we then simulate the potential scenarios that would result in the Latin American Caribbean region. And for these simulations, we considered two scenarios, one of lesser growth in the US and another one in which the financial markets feel a bit tighter than the baseline scenario. Both scenarios can be related to challenges to contain inflation in the US or based on the current financial stress situation that is being observed. So what would be the impact of the LAC region if the US growth rate is on the order of 1.6% less than what was expected, and 1.6% is a standard deviation applied to the US growth rate. So if this happened, then the region would then feel an impact on the order of zero 0.8 percentage points over the next 3-year period that we are using for the simulation. So this would be under the baseline. It would mean that the region would go into recession with an average annual growth rate of less than 0.5%. In 2023, this might improve in 2024, and it might acquire 2% in 2025. And through various, all of this would impact the various cross-cutting economic and trade circumstances in the region. So what happens with financial costs if we use a standard deviation in the reduction of cost of 1.6% loss in the US stock market? This would then lead to perhaps a zero growth rate in 2023, 0.4% growth rate in 2024, and the region once again would achieve a gradual increase until acquiring the 2% growth rate in 2025. The drop in stock prices could result due to higher than expected interest rates, which could be an expected income from higher interest rates. And it would also imply certain losses in the stock market, similar to the ones that we've been observing in recent times. Now, if we look at other shocks during tighter financial markets in the US, then we might see a recession condition in the US with losses on the order of 1.7 percentage points over the course of this 3-year period. Now, once again, these simulations use extreme values, and that's why in this report we refer to this situation as a negative scenario. But the key message behind this exercise is that the region is vulnerable and very vulnerable to external shocks. And for that reason, we require well-designed policies to be able to mitigate these disruptions that are external, and we could mitigate their impact in different economic spaces, many of which are facing this triple challenge. To try to address and ensure that these effects are minimized, we need to come up with key policy making to address inflation, the process of fiscal consolidation, and better policies for the financial space. With that, I will yield the floor to my colleague, Victoria. Thank you very much, Arturo. Let's begin with inflation. 2022 was a year in which inflation grew. The average median inflation rate in the region went from 2% to 10% in many countries, and every country saw an increase, or that saw an increase in their inflation. They saw a higher rate than what we saw in 2022. In most countries, inflation appears to have reached its peak and it's going back down and approximating its stability point. But one very important risk that we see is that a very high persistent inflation rate could affect these perspectives. And this could lead to inflation becoming more permanent in the long term, which will affect the costs of goods and services. So clearly, the region is experiencing, at least at the outset, some of these global impacts. And one way to address this would be to consider different factors. We see a deconstructed grouping of models here applied to different character or parameters. In 2022, more than 75% of the inflation dynamic is explained by shocks in fuel costs. If we see that the inflation indices had a play or played a role in this, but this is now acquiring less importance. And now the inflation dynamic in most countries is facing a great deal of risk in most countries, particularly if there is greater uncertainty or if the Ukraine war intensifies greater than 2022, the opening of China, the closure for COVID also has an impact, or if the financial markets uncertainty can also create a great deal of disruption. One of the things that we need to monitor is inflation for food. In 2022, inflation for food were on the order of 14% or percentage points. And this accumulated inflation for food has been on the order of 33%, which is alarming because food is a primary expense for low-income families. And this, with higher food prices, can lead to food insecurity, a great deal of social discontent, and would worsen the triple challenge that we've already mentioned. Now, when we talk about food insecurity in the region, this has been growing even prior to the pandemic. We can see the malnutrition rate, which has been increasing along with poverty. In addition, it's higher than the average for the entire world. So there was an exercise conducted by colleagues at the IDB, and poverty and extreme poverty could increase by 2.3 and 2.5 percentage points respectively, which is equivalent to 13.8 and 14 million people. This underscores the importance of controlling inflation and dealing with food insecurity and uncertainty and poverty in the region. The strong monetary policy response for countries in the region is key in terms of inflationary policy. Like it was done during COVID, today, on average, interest rates have reached 600 basis points, and the countries in the region have responded in a much stronger way than the G7 countries. And in terms of monetary response, in most countries, inflation has been stabilized and is trending downward. By 2024 and 2025, we expect that inflation will reach its stable point. And to be able to ensure this, it's crucial to avoid any contradictions with other macroeconomic policies as well as wage policies. Salaries have been increasing with the prior inflation rates, and it's important for us to monitor these and assess these to develop more updated policies. But given the complex circumstances that we face, we may not be able to address the issues stemming from the triple threat. Consolidation and the process thereof, the fiscal consolidation process that was undertaken after the pandemic, has trended to be positive, and this is reflected in a reduction in overall debt, public debt. We managed to get to 71% during 2020 as a result of or as a share of GDP, and we've been able to make improvements on this. Now, this doesn't imply that there are not challenges, especially those associated with higher financial costs. We estimate that due to the increase in interest rates that we saw last year, the region today is paying 2 percentage points more with regard to their fiscal income than prior to the pandemic, whereas on average, the region paid approximately 10% of its total fiscal income, and other countries paid 9.7%. The highest financial costs affect a country's ability to invest in infrastructure. It also exacerbates inequality and limits the growth potential for the medium term. Now, the combination of these high financial costs and lower economic growth presents a very difficult scenario for the coming years, and it could lead to the downturn in the increase of public debt and income. Now, this can also be affected by other factors, and the negative scenario that was expressed by Arturo, which is the line between these two graphs, could lead to an even worse situation, which would lead to higher financial costs, which would not only limit the fiscal space, but it could also restrict the extent to which new policymaking could bring about more positive change. Now, in the region, we see that the vulnerabilities based on international financial flows are increasing compared to prior stress episodes. And I'm referring to the 2008 crisis and the global pandemic in 2020. The situation now is more weakened than it was previously, and the outlook is not very positive. Now, the current deficit in the region is already worse than during the previous period. Now, we have seen an increased trend in dollarization in different arenas. International reserves are growing by and large, but the region needs external savings, and any tension episode in the markets that becomes critical could restrict this flow, and this could also exacerbate the economic and social situation in the region, and this would lead to a greater disruption. In terms of domestic parameters, the good news from COVID is that the region's banking system was not part of the problem and remained solid. The banking system in the region, which is represented by the graph on the left, showed that the pandemic did not affect many of the loan risk indicators, but the ratios of capital adaptation on the right also did not suffer any strong changes. Now, there were some actions undertaken to mitigate any potential increases in risk during the pandemic, but the bad news is that financial activity has been weakened significantly over the last 2 years, and the financial system is expanding its limited access to capital. But the situation that we see in the banking sector in the US and in Europe can also be seen in the region. The countries in the region have a homogeneous mechanism for their entire financial sector. Now, notwithstanding some of these other disruptive factors, we cannot set aside the progress made in the financial sector. And as we stated, the bank system in the region appears to be pretty solid. Now, all of this implies that we need to be very strategic when it comes to policy making. financial cycles, or rather economic cycles, can hit us very strongly, and they will always be there. But what is crucial is our ability to create spaces for the most vulnerable populations through the most trying times. And that way, we can, in the face of these global and domestic cycles, the trends towards closing the gaps and facing these challenges can be maintained. In the macro arena, we could look at short, medium, and long-term policies. And today we need to focus on three main aspects. First, stabilize inflation. Additionally, improve conditions for fiscal consolidation. And in third place, achieve a higher productivity. To stabilize inflation today is extremely essential. We need to monitor the dynamic in the prices of some global raw materials, especially those that mostly affect the region. Global uncertainty could affect the global interest rate that will create an impact on monetary policy, and all action needs to be focused on maintaining this convergence, ensuring the independence of the central banks. And in that way, we can continue to maintain the credibility of central banks, the expectations, and the efficiency and effectiveness of monetary policy. Fiscal consolidation is a challenge, particularly during a time when there is a greater demand for fiscal resources. It's extremely necessary in the current time frame. Now, this can be achieved with a combination of policies within the regulatory framework, such as adjusting certain types of expenditures and focusing subsidies on the most vulnerable populations, developing implementation and administration management strategies. In the medium term, we need profound fiscal reforms to be able to improve effectiveness and efficiency in expenditures and create a more progressive tax system. The design of tax systems need to be adjusted to current incentives. And in order to improve productivity, policies need to focus on reducing infrastructure, both physical and virtual resources, to be able to drive increases in productivity. Additionally, our justice systems need to be strengthened. The corruption in the economic and governmental arena also need to be strengthened, and we need to have policies that focus on eliminating these uncertain and corrupt practices. Now, how can we bring about the commitments which are so important to be able to promote a greater transparency and effectiveness? We need to address policies that deal more effectively with cyclical phenomena, and this would then bring about mechanisms that can face this triple threat in a more effective way in the short, medium, and long term. Thank you very much, and I'm happy to answer any questions. Thank you very much, Victoria, Arturo, for your excellent presentations. I'd just like to say to everyone that this is just merely a 25-minute summary, so please take advantage of the availability of the macroeconomic report published by the IDB. We have it both in Spanish and Portuguese versions, in addition to English. In addition to our two keynotes, we have two very important guests, Solange Burstein, who's already with us. She is currently the president of the Financial Market Commission in Chile. She worked previously for the Chilean Central Bank and at the IDB as well. And she was the director of pension systems in Chile. Thank you, Solange, for joining us today. We also have Pablo Guidetti. He's a professor at the University in Argentina, founding member of the Latin American Committee on Financial Issues, has worked extensively with public and private entities in and outside of Argentina. He's served in the Ministry of the Economy and also held several leadership roles for the Bank of Argentina. Welcome, Pablo, and he joins us from Chicago. It's a pleasure for me to be here. The idea today for this panel is to have a discussion both with Solange and Pablo. I will give each person a couple of minutes to refer or provide some insights about the bank's macroeconomic report. Then we will undertake a Q&A session. So let me yield the floor to Solange, and then we will go to Pablo. Thank you very much, Eric. Thank you to the IDB for the invitation to take part in this very important event. And I want to congratulate all of the team members that worked on the development of this report, which undoubtedly comes at a time that is particularly important, that requires that we engage in this thought process at the global level as well as the regional level. And it is much more relevant at this time than it might be in different contexts. I wanted to focus more on the financial arena, which I feel closer to. We have undoubtedly gone through some very difficult years, not just in terms of how we've been impacted in the region, because we have become accustomed to crises, but we're not that accustomed to global crises. And this has allowed me to just study the history over the course of the past few years and everything that we've faced. And as it was said previously, when we talk about the financial markets, we've, on this occasion, been more a part of the solution rather than a part of the problem. But for that same reason, because they haven't been years that could be deemed other than difficult, it has been necessary for us in the sector to respond and to look to the future as well. So we've been trying to tighten up some of the loose ends or strengthening some of our weaknesses, especially in the fiscal space. Now, when we talk about the banking system, as it is quite accurately reported in the macroeconomic report, we have seen some advances at the global level and the regional level, but they've been impacted in a variety of ways, access to credit and other factors. And we see how the banking sector is showing that eventually its capacity to face and recover in the face of a new shock is becoming more difficult. And so the banking sector needs to start to address other credit access challenges. And it also needs to deal with much more complex scenarios than those that we've seen before. And there's a great deal of vulnerability that needs to be addressed and even projected for in the global context as well as the regional context. So clearly, the banking sector has seen an increase in the issues that they have, but the support measures in many countries were also supported by government policies, especially in the fiscal space. In the case of Chile, I'd like to just discuss Chile's experience in terms of the measures adopted during COVID. There were additional measures that required the coordination from all the different stakeholders, and we had very important advances in fiscal and financial and economic policies. And this was something that was very helpful, especially in Chile, because there were measures on liquidity from the central bank that favored the financial sector. We created greater flexibility in the regulatory standard framework that also allowed us to maintain the lending channels open. And this clearly was very helpful during a very difficult time because we were facing a transitory liquidity problem. Clearly, what was done helped contain the defaults and the lack of income for many companies and many homes, so that could have contributed even more to the problem, and there could have been a heavy contraction in the loan industry. And through that possibility, many companies were able to overcome some of the challenges, but not all of them. So we have continued to monitor the situation. We have seen some default issues that are starting to come up a little bit more frequently. So I just wanted to highlight the important role that the bank plays in all of this. Now, clearly, we are facing many contingencies in which the regulatory frameworks for the banking system are very, very important. We have a very solid framework that has proven to be very strong in the region. A number of countries already have some systems already in place. Others are working on that. Argentina and Brazil have some of these systems implemented. In the case of Chile, we've progressed enormously in the implementation towards these new systems. So we have a global standard regulatory framework that allows us to be more resilient in the face of events such as these that will allow us to measure for future potential scenarios. You never know what we may have to face in the future. And when we talk about resilience, we have to look at resilience in other entities and agencies, in financial agencies and entities. We were commenting in the Congress today in Chile. We were talking about a resilience project for the financial sector, whereby a number of measures would be implemented addressing liquidity and other similar issues. And that was a very good and very interesting experience that we've been undertaking and that we've been monitoring. But the types of measures that are being developed there can be added to the types of policies that we've already heard about here. All of this needs to answer the question of where we can address all of our key vulnerable points and how can we address the insufficient capacity that we have at the present time. And so we have to be able to address all of these things in the future, and that's what Chile is intending to do with this project and this bill that they're considering in the Congress. I did want to focus on 2 points contained in the report that affect the medium and long term, and those are climate change, and it's important for us to include that in the report. Growth cannot just merely be framed as resilient in the face of the usual phenomena, but we need to also consider potential phenomena, and climate change needs to be included in that subset of scenarios that needs to be addressed. And the financial sector has a role to play in this. It needs to take charge of all of these risks, and it also needs to play a role in terms of promoting investment that can contribute to a lower risk in the future. The other thing that I wanted to point out in the medium and long term, and that's very important that we include in the report and very important for the region in general, is the disturbing growth in inequality that we have at the present time, especially in those lower income homes. And something to highlight there is a new role for the financial sector in which greater financial inclusion could play a key role. Inclusion requires education for us to bring about access to low-income people to the financial sector. These are people that need an answer. They need the capability to interact with the financial sector, and that's a very relevant issue for us to address. And additionally, it involves more accessible financial services, particularly to those most vulnerable. And in Chile, we're trying to work on a new legal framework for these fintech companies, companies that offer tech-based financial services. We believe this to be a wonderful opportunity for low-income families, but it's also a huge challenge because many issues need to be overcome to be able to address the needs of these people. Clearly, a lot of doors are being opened by this report, especially as it relates to resilience in the economy, the financial system, and the future growth of the region. Thank you very much.
Thank you very much, Solange. Those are very interesting comments. I'll try to summarize them. Today, these crises that we have can be exported to other countries, and we want to be part of the solution and not the problem. So we need resilience in the financial markets, but we need to continue to work on the reform of various regulations and laws. And at the same time, we need to go beyond that slogan for inclusive, sustainable growth and make it a reality in some way. You talked about climate change, inequality. These are challenges that the IDB also wants to work on. So thank you very much for those comments. And now we go on to Pablo. Thank you very much, Eric, Arturo, and Victoria, for this invitation to contribute my comments regarding this report. I want to congratulate the whole team, the research department of the IDB as well, on this work. Our region is particularly complex and diverse, and it's not easy to put together a balanced snapshot of the entire region or of an average country. We have countries that have different monetary systems, countries that have fiscal weaknesses, countries that have fiscal strengths, countries that are commodity exporters, others are net importers, countries that are highly dependent on some types of revenue tourism, others are more diversified. And I think this report really succeeds in conveying the message about this region and taking into account all these differences. Of course, when we look at the prospects for this region, currently, a lot of what we see is based on the external context, and this is a context that has been especially challenging, as we've already said, because we had the pandemic on the one hand, and the pandemic, interestingly, generated two different types of policy responses. One was a response that forced a supply reduction because of the health measures. And then there were others that stimulated demand. And if we look at the case of the United States, this didn't just mean a fiscal expansion, but also an enormous monetary expansion. When we look at the M2 or the balance of the Federal Reserve during the pandemic, we see that it goes far beyond what had happened during the financial crisis, the global financial crisis that we went through before. And the US didn't just resort to lowering interest rates, which went down to practically zero, but there was also another part of the response in a context where we said there was a supply reduction. So perhaps this policy, which at the time was deemed necessary, was also at the same time the one that triggered inflation or brought back inflation after many years of low inflation and of actually struggling against deflation. And it's a phenomenon that had and has global characteristics. It is of a global nature. And it has new features in terms of monetary policy. And this makes it difficult to understand how the future will look, because we have, on the one hand, an increase in interest rates and conventional instruments. Then we have that quantitative tightening where we turn around the balances of the central banks, etc. And then the fact that all central banks are at the same time betting on restrictive monetary policy. And this could magnify the effects of this monetary policy if we take into account exclusively what one country is doing. In all the countries, there was a need to provide a fiscal response. And this meant obviously that public debt compared to GDP grew enormously in advanced countries as well as in emerging economies. And we see that leap to 71 and then it came down. But regardless of that, and that's related to a drop in GDP. But reality is that if we look at current levels, compare them to pre-pandemic levels, the fiscal response generated a significant increase in public debt ratios. And added to this was the impact of Russia's invasion of Ukraine with the effect on food prices and energy prices. So it's very important to understand how the situation evolves, the external situation evolves in order to understand our own situation. And then added to that, now we have issues in the banking system. These have been a surprise that has come up in the last 2 weeks. And I would say that before these new banking problems cropped up, I was relatively optimistic about the evolution of inflation and economic activity in the US, and particularly because a lot of this discussion has to do with the Phillips curve and whether it's still relevant or not. And the fact is that when we look at the US, it's interesting to note that when monetary aggregates and the Fed balance is dealt with, that's when inflation starts to come down. And maybe we were in a scenario where inflation was going to drop significantly without the need for a recession or for a marked recession. So in January already, people were discussing the persistence of inflation, but in a certain way, it was a more optimistic viewpoint, and the IMF was predicting more optimistic growth prospects. And all of this means that 2022 was a year that was particularly bad for capital markets in emerging economies. If we look at JP Morgan numbers regarding flows to bond markets and shares as well in emerging markets, but if we look at the bonds market, 2022 has some cumulative outflows of capital at the rate of 85 to 90 billion dollars, which is something that hadn't been seen in the last 16 years. The only year where we had net outflows of capitals in these last 16 years, besides 2022, was 2015, where it was 20 billion. So the impact of this whole series of shocks and uncertainty on the markets was significant. And the report mentions the fact that Latin America maintained its access to the capital markets. And it's true that the situation did improve at the end of 2022, and it improved in particular in the month of January of 2023. But it's also true that it's been a very different effect between the countries that we refer to as high yield and the ones that are investment grade. And I think we have both kinds in the region. And that's where, when we look at the NB at the level of emerging markets, the high yield spread increased to above 1,000 basis points after the beginning of the war in Ukraine. And these are levels comparable only to the first weeks of the pandemic and the global crisis, the global financial crisis of 2008, 2009. And the MB investment grade didn't really move much. It was pretty stable. And I think this is a reflection of the fact that when we take the average of the region, we see that there was an increase in the international rate. These are the points that Victoria was showing, and the spread stayed at a relatively stable level. But the reality is that behind those relatively stable averages, we have significant differences in what is happening in different types of, or these different groups regarding risk. This scenario, these crises that we've seen in the last 2 weeks with the closing of SVB Signature Bank and then Credit Suisse. How has this affected us? When we look at the reaction of regulators in the US, of the Federal Reserve, we see that the response has clearly been a quick and very definite response, almost unprecedented, when this guarantee was extended to deposits that were not insured. And this is good news because it shows what we've learned during the financial global crisis. And this means that regulators today intervene much more rapidly than they did at the beginning of the global financial crisis. That's good. But at the same time, this does convey a certain level of doubt as to whether there are more problems that we haven't heard about yet. And in the US, the institution that was next in line, that was First Republic, it seems today that it's doing better than we thought a few days ago. And the purchase by UBS of Credit Suisse has generated a total loss in bonds equal to $17 billion. And this is still a mystery, still an unknown. I always say that it's not the loss of assets where we really see the loss. It's in payables, and when that doesn't happen, liabilities, that's where we see it more. And the response in the US meant that banks requested close to $200 billion in liquidity. And this is much more than was needed for the global financial crisis. So it's a significant shock, and we still don't know how this story will end. And obviously, if the situation continued to worsen as it did in 2008, then for the region, this would mean a higher likelihood of a sudden stop, of a significant sudden stop in the region. But to the extent that this crisis might be contained, successfully contained, then I think perhaps the long-term impacts might even be positive, because obviously it will contribute through credit to a slowing down of the US economy. And many people thinking of the Phillips curves were concerned because the economy was too strong, too hot, and they thought the interest rate was going to have to go up a lot. Perhaps this will take care of that in a way, and we'll have an interest rate in the US that will not increase excessively. And where I think it's necessary to imagine a world that will be very different from what we're familiar with since 2008, it's here. I think the world of the future is not a zero rate world. I think it's healthy to think about a 10-year rate that's at about 4%.
And that would correspond, that falls within the 2% target, in addition to 1.5, 1.8 actual rate. So there's no doubt about the fiscal challenge that we face. I share the vision contained in the report when it says that monetary policy in the region acted appropriately, very appropriately, in fact. Central banks reacted much more quickly than the Federal Reserve Bank. They didn't lock themselves into the lower for longer, flexible inflation targeting. And perhaps due to our history with these things, Brazil was the first one to increase rates, but they were followed by Chile, Peru, Mexico. So in 2021, we saw very rapid responses, whereas the Federal Reserve waited until 2022 when inflation was at 9% and the monetary policy rate was at 0.25. So I believe that the response by the central banks has been very good. And based on what we see in the region, this is imported inflation. And it's very hard to try to countermand that type of trend. Where I also agree in the report's message, or with the report's message, lies in the need to emphasize fiscal consolidation. And in this regard, I would say that my vision is a little bit more rigid than what is contained in the report. I think that the debt levels that can be managed in a sustainable way by the countries in the region, I don't think are very much higher than 40%. For me, the numbers that the IMF uses in terms of fiscal rules, I think are too lax. And there are many countries that have had debt problems with, we're talking about debt restructuring problems and leverage problems on the order of 50% or more. Undoubtedly, some countries have benefited and have been able to address the crisis very effectively, such as Chile and Peru. And those are countries that have had a very healthy fiscal policy in place for a number of years now. So I think that in that sense, we need to place greater emphasis on countries that face greater vulnerability in the face of international capital markets that have more restrictions, such as many countries in our region. And those are countries that need to manage lower debt levels. And that's an enormous challenge, in addition to all of the social challenges that these countries face. And we need to be able to face this with much greater efficiency in public expenditures. Perhaps an important role of organizations such as multilateral organizations or the IDB is to try to produce these regional public goods and include energy use and try to ensure greater integration in the region. perhaps we could then bring about a much more effective production and integration. Some countries have an island mindset when it's compared to a region that could be much more integrated. I think I'll conclude with that. There's another topic that clearly won't be addressed directly in an IDB report, but is important for me, and it has to do with the role of the fund in the region. Today, the fund has two main programs that are not working due to different reasons. The Ecuador program, whereby Ecuador is undertaking extensive efforts in fiscal matters, but it's not working due to its political weakness. We have another country like Argentina that's doing everything incorrectly, and that's why that situation is not working as it should. And evidently, the fund has as its objective to refinance the increased access program that they have in place at the present time. So I think that there's a phrase in chapter 6 where it refers to multilaterals, or it calls for multilaterals to try to help countries in the region to improve their maturity structure, the liability management in general. And I think that there needs to be, in countries such as the case of Ecuador, there needs to be a new effort, and I include Argentina in this, a new effort undertaken to generate the conditions to go back to the capital markets. I think that many times I see a conflict of interest. On the one hand, the fund doesn't want to extend loans to benefit certain stakeholders, but if there's no confidence in the sector or in the market, then there won't be any resources to pay the fund back. So it's a very serious problem, but perhaps it could be a problem that requires that the fund think in a more detailed way how they could help improve the profile of a number of countries' liabilities profile. Thank you very much, Pablo, for all of your insights. You did mention a lot of ideas in a relatively short period of time, but you could say that we have an issue of a counter-cyclical reaction on the fiscal and monetary policies side, and that we need to try to continue this drive to avoid any impact in economic activity as it's being done in many countries in the world, not just in the region. You also said an interesting thing about the banking crisis and how this could bring about an important impact in our countries. And I'd like to take this last idea to pose a question to Solange. Many of the people that are joining us today virtually and that are here in person are interested in thinking about shocks or financial shocks that are occurring in the US and Europe and how they can affect the region, and especially on a focus of what lessons we can derive from this. We learned a great deal of lessons from the 2008 crisis. We had better regulated capitalized banks as a result. And as it shows in the report, clearly banks have on paper a great deal of liquidity, but they're not really resonating a great deal in the region. So what could we think about when we talk about a reform agenda on the financial side? And what can we do with the innovative financial elements in the sector, the fintechs and other similar entities? Solange? Thank you, Eric. These are important topics. And as we were discussing here when we were trying to foresee the overall impact of what we're experiencing, and what we see primarily is a risk containment scenario. And we're targeting some things that we want to resolve in a rapid way with the help of the authorities. but we haven't had what you could call some easy weeks these last few weeks trying to understand in depth what the causes are for some of these events that we've been observing that have been taking place and that we, as of yet, don't know how they're going to turn out. And this is something that you mentioned too, Eric. Where do we go from here? I think that first, I wanted to link this to one of the exercises contained in the report that have to do with the capital deficits held by the bank. It would be interesting for us to look at the region and simulate what would happen if we had any kind of a capital crisis in this sector. And the likelihood of a capital deficit is greater apparently in the larger banks. And so we need to take a look at everybody that participates in this sector. And it's just an analysis of the possibility. I'm not claiming that this situation exists, but this type of risk could really propagate very rapidly through the financial system. And this could start with an institution that is lower. And this is something that we have in the region, regulation that is very closely aligned with the banks, the with the banks, regardless of their size, notwithstanding that some of these the banks are significant. Many of our countries have less banks than the U.S., and we need to monitor them properly. In Chile, we have a number of banks, and we're looking at all of our banks that include the low or the smaller size banks. And there are a number of issues there. When we talk about banking regulations, what we understand is that we want to set a very high standard when it comes to bank regulatory standards, because there are very important risks involved. And these are situations that can be highly leveraged. And when we talk about capital assets, we need to ensure adequate strength in the system to be able to navigate through any storm of this time. Something that is discussed at length in the report is the importance of tools such as stress tests or tensions tests. It's important for us to continuously model these stress situations, not only with regard to capital capacity in the banks as well as stress. And I think that for those of us who regulate the financial and banking sector, this type of tool reinforces the message that we're trying to continuously convey to the private sector. And that is that these tools and that these indicators that we follow zealously and that imply compliance cost. There's a cost for monitoring and other activities that are important to ensure this degree of certainty. And this seems to be the mistake that we make every time we have a crisis. And when we talk about capital markets, we're not just talking about these stress tests, but we're talking about things that we need to be able to incorporate capital parameters that need to be reported by the bank, that need to be monitored. I think this is something that's very important. So I think that these are tools that are extremely useful for us to be able to understand the risks inherent in the balance sheet on many banks and how they have the necessary capacity to address critical situations. So in the capital markets, it also applies, and it's a very important component because we can't just undertake the stress test, but we also need to look at how we overcome and get out of these stress conditions. In the case of Chile, one of the lessons that we learned that reinforces this new message is that the central bank, through its Office of Supervision, has been working on banking resolutions that we are still working on. There's a proposal, a document that was published just a few weeks ago by the Financial Markets Commission to bring about legislative regulatory changes in Chile. Some are proposing the creation of an institution to be able to address these crises in these types of institutions. And what we've seen in the US helps us highlight the importance of having that type of instrument. We also need to be able to intervene in the early stages of any crisis and other tools, which can be very helpful in the current regulatory framework. Now, in terms of liquidity, which is what at the end of the day is the main topic behind all of these events that we've been observing, liquidity, some of the efforts that we have include some indicators for liquidity in the short term and the liquidity capital ratio in the long term, the SFR or the CFR, that is. And in these cases, we have some mechanisms implemented. And a recommendation, not so much a mandatory requirement in this regard, is the resolution, because it won't just contain the indicator, but it will also, like the capital case, will have the self-assessment, and it will also have the liquidity component. And we will also have this requirement for all banks to conduct a self-assessment of their liquidity. And so this is something included in a report by which banks will report all of their management systems for their liquidity systems. And it's not just an indicator. This is something that we look at all the time, managing liquidity. The central bank is key to all of this, especially when dealing with bank solvency problems. But having these tools available to the oversight bank would be very important.
And the report does mention that we need to have peace of mind in the financial sector, but clearly our peace of mind is not complete. You know, we have peace of mind, but we're nervous, and there's again a challenge from the markets. And I hope that what Pablo was predicting as the best scenario is what actually happens. So we want to limit exposure to risk of rates, etc. How do we mitigate exposure to these risks? Because the situation could become more complex. These stress tests are important, as we said, and coordination among authorities. This bears repeating. And regarding this aspect, and to go back to your point that you had made about financial innovation and also innovation in other entities, as I said, this is an opportunity and a challenge. It's an opportunity because it generates new channels for credit. And this is important in the market, not just the banking financing, but the capital market established. As we know, it can also be a channel, but also new ones and different ones as well. There are other ways to reach different types of businesses to fulfill their financing needs. And this is where we can play a big role with the private market, with the private sector, but with the proper regulation. We don't want risk coming from other parts, so we squeeze the bank with a strict regulation framework, which is necessary, undoubtedly. But if we then allow other channels to open up through which financial services can be opened, how do we have proportional regulation to allow for their development, but without incurring risks where we end up having risk for the financial sector again, and then at the end ultimately it will turn into a situation that is just not sustainable in the long run. We want financial innovation that is sustainable and that can be an engine for development. And that's what we're dealing with. And in Chile, with our new legal framework, that's our objective. And I think it's going to be an interesting process. Thank you very much, Solange, for your very candid comments also about reforms to the Chilean financial sector. We don't have a lot of time, but I'll give you a minute and a half, Pablo, to tell us a little bit about political polarization, how important this is in terms of trying to reach agreements and succeed in making long-term reforms. A lot of governments are dealing with this right now. Yes, undoubtedly, the region in the last few years has faced growing polarization in the political sphere and instability. And obviously, this situation has a significant impact on the investment environment, the climate that investors see, and we need a positive investment climate so we can have the rates that we want and so that we can institute these long-term reforms that we need. There's no one-size-fits-all approach for polarization. Each country is different, and I think the political process is different in each country, and it's going to depend on that. But in general terms, what I would recommend is the following. In the 90s, when globalization and the Washington Consensus became important, an idea of how we could improve direct foreign investment. At the time, this was a very important financing source for countries. And at the time, it was said that we needed to have frameworks that protected the rule of law, the stability of regulatory systems. And that's where the bilateral investment treaties that came up, ICSID was created. And perhaps this would be an interesting exercise to go back to assess whether those treaties, whether ICSID have worked effectively and efficiently and are doing so today. Obviously, all of these legal processes have their own dynamic, their own patterns of action, and we need to assess whether they are still fulfilling that goal of improving conditions for direct foreign investment, and are there other institutions we can think of that can help us improve those conditions? That's great. Thank you very much. That's a very important message, Pablo and Solange. That's the wrap up of the panel. Thank you very much for being with us and making time out of your very busy agendas. Thank you very much for the invitation. It's been a pleasure. Likewise. And I want to thank Victoria and Arturo once again, the editors of the report. And again, I invite all of you to read this report. It's already available online. You can download it in English, Spanish, or Portuguese. Thank you to all of you who are here with us in person and those who have joined us virtually. And let's think that these reforms that we're talking about are long-term reforms. This is a marathon, not a short race. And the IDB wants to provide support, wants to be a partner in dialogue and a support in implementing the reforms. We'll see you soon at another IDB event. Thank you for being with us.